Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And here this, let's call it middle of the year recap. Take a look at what we've seen thus far through 2023 in the precious metals and a couple adjacent markets. And I figured for doing that, the best person to potentially look at the longer term recap is the guy who's got the longest term in gold of anybody on earth. And that would be Rob. Welcome back, Rob.
Thank you, Miles. Good to be here.
I have to take one shot per show that I have you in on. Is for all those years that you bothered teaching me things when I first came to work here and putting up with me. So thanks for coming in again. Yeah, I thought your idea was a great one. Following the 4th of July, we're now into the 7th month of the year. That means 6 are out of the way for those of you that do math like I do. And you realize that, man, the year's half over already. So the question is, of course, what have we done so far in the markets? Some of the markets look better depending on where you start, like say December, January, than others, but maybe not so good when you look at them long term, like say the Dow. So we'll jump in and take a look at a couple markets here and what we're looking at long term. And then, of course, what the precious metals markets, where we think we might be going over what I initially thought was the next 6 or 8 weeks, but you may have convinced me to think a little shorter term than that.
Yeah, I think we are within just a few weeks of where we will call the mid-year bottom. When you look at gold specifically, you tend to break it up into 3 categories. You have the seasonal cycle, you have the technicals, which you are an expert in.
A practitioner of,
and then you have the fundamentals, or what could be called the black swans. Unforeseen events like Russia, Ukraine, COVID, etc. So it's hard to say what the black swans are going to do. We don't know. We do know that China and Russia are moving aggressively towards some kind of BRICS arrangement that isn't just what they've been talking about for years now. They're moving aggressively. So we'll see fundamentally what that black swan event looks like, the de-dollarization, et cetera.
Right.
They're talking about a gold-backed currency. Who knows? I just don't trust politicians when they tell me they're going to back our currency with gold or anybody's currency. But looking at it seasonally, like you and I were, why don't you break down the seasonal aspect for gold?
Sure. So I think that's a good way to kind of look at it from a recap standpoint, because you really do have the 3 factors. As much as I hate to admit it, there are seasonal pressures on metals. The thing I love to admit is there are technical aspects to markets. And the thing Tori loves to talk about is there are fundamental things that move those trends over extended long-term periods and sometimes have shorter impacts as well, at least as a reactionary standpoint. How are markets reacting to news events? So seasonal, technical, and fundamental.
Which is what people react to.
True.
People react to those fundamental, out of nowhere developments.
Right. Well, that's all a market is. It's just a group of people all making decisions, and which decision wins moves the market in a certain direction. So you look at something like gold, which obviously is having an okay year. If we stretch that back to October, November, it's having a phenomenal 8 months.
Right.
But we'll just arbitrarily take January 1st. So we're looking at gold up about $100.
5% or so.
Not a huge move. It was up significantly higher. In fact, all-time highs just shy of 2,100, and now taking this step back. And we looked at some of the retracement levels on gold last week. We'll point them out again. Last week, we had the lining up of a few shorter-term and medium-term Fibonacci levels around like 1909. We had a nice little bounce down below that and came back, and now we're back up above it. But the thing you and I have been looking at is the longer term, or what I would call the medium term, the start of the rise back in November. The Fibonacci levels there and how that relates to, say, a long-term 200-day moving average, and what kind of step back could we be looking as it coincides with what you just asked me about, the seasonal trend. So when we're talking about the seasonal trend, there's something that Robert and I had discussed a couple years ago, and we see this interesting pattern where you tend to have 2 periods of time where precious metals, especially gold, tend to be the most active. We tend to have a summer push, and we would argue more times than not in the summer, you tend to see bottoms in the gold price.
Right.
And then you also tend to see I don't want to call it a winter push, but that kind of makes sense because it's like December to March. And more times than not, you tend to see annual highs between those months. Certainly the last couple years. We've had some pretty exciting Marches since 2020.
Yes.
So that tends to be the case. It's not 100% accurate, but more times than not, you tend to have lows in the summer and highs around January, February.
But you're redefining summer.
Yeah, and that was interesting. We were talking about this earlier, and my brain, because of living in the mountains of Colorado, and when it's hot, my brain thinks summer is June, July, August. But when I'm looking at these market charts, I'm finding we're having seasonal lows or seasonal highs, not averaging July with a few in June and a few in August. It's more averaging June with a few in July and a few back in May. So what concerns me about this is as we're putting in a low here now at the beginning of July, could that continue down? Of course it could.
Well, it's frustrating for me because I've got about 600,000 waiting to buy and about a little more than half that much coming in to sell, people needing to raise money. And it's very hard because I think we're within 2 or 3% of what will be the bottom for the summer doldrums.
Sure.
Does that really matter? I know it matters to the people trying to sell, so I feel an urgency to people who need the money to go ahead and sell now before we see another 2 or 3% drop. But then with the money I have waiting to buy from my clients, I don't want to be too cute. Will 2 or 3% matter in 5 or 10 years? Not even.
Right. And when you see those patterns develop over 10, 15, 20 years, where it's probably 75, 80% of the time, you can say we're probably going to see a bottom sometime, again, not June, July, August, but more like May, June, July.
Right.
Now we're into the end of July. We're seeing gold continue to slide off. No,
We
just had July 4th. We're now into the beginning of July,
so
end
we're
of
close.
June.
So if we're going to see the bottom of the summer doldrums, we could just be a few weeks away, if that.
Right. So you've got some seasonal argument there. I wouldn't bet my house on it. Yeah. But then you bring in the technicals, and you're looking at us playing around right at that first shallowest potential reversal point now, that longer term 382 fib, which is right where we're at. And when I bring in the 200-day moving average here, I'm looking at the 200-day moving average just touching or just crossing past the 50% line, which is only $60 lower than we're at now.
Right.
I mean, we're not talking a significant move down.
We're not.
And you could literally see gold take a $60 decline tomorrow for some reason. I don't know if it's going to. I'm not predicting anything. I'm just saying hypothetically. And now all of a sudden we've hit a massive trend line, probably get a big bounce. And whenever you have those technical bounces, you're just going to waste 2-3 weeks just figuring out where it's going to end up. Once the dust settles, where does that end up landing? And now we're in August. So could gold just kind of park right here for 3 weeks? Sure.
Easily.
Could we see another $50-$60 down in gold? That actually would be real healthy.
Very healthy.
And we're not even at the 618 fib yet.
No.
That's just the 50% line. And the 618 fib's only $50 cheaper than that. So you look at where this all started, again, not January 1st, but back in November. We're just scratching the surface, and it could be over soon.
Yeah, and that's my thought. I'm feeling in my gut that we're coming out of this trough, if you will, and we'll either be moving sideways or trending higher. The biggest problem is nothing is fixed. Nothing is fixed. Everything continues on. We could be weeks away from a sell-off on Wall Street.
Sure.
Pull out your Dow chart. Show people.
All right. Yeah, let's look at how dead in the water the Dow is right now, which kind of fascinates me. I've been pointing out this shelf ceiling that's been sitting on the Dow for, 8 months.
Yeah.
I mean, we're talking the big jump up we had back September, October, November, where the Dow had declined all the way sub 29,000 and then rocketed back up to 34.3. But man, we can't get above it.
No.
I mean, we've touched it 1, 2, 3, 4, 5, basically 5 times now, and we just can't seem to push above it. So could we? Yeah, of course. Like, I'm not oblivious to the amount of money that can get pumped into the equities market if necessary. But Tori and I talked about this last week. The only thing really holding the equities market up right now is the Nasdaq, is the AI tech stock craze that's been taking place for the last couple months, because we overlaid the Nasdaq with the Dow last week, and we saw this very clear pattern between both, but then this massive split a few months ago where the Nasdaq just kept rising. And
it's
the
up
equities
over 50% for the year.
And still below the highs, which I think is an important thing to factor in. So you need to look at the whole market on a multi-year basis to get a feel for what your long-term trends are. And then you look for opportunities to jump on the coattails of those trends. So I think you've got an opportunity to do that in things like the precious metals. I was hoping we would get an opportunity to do that in things like treasury bills if the interest rates were rising. But it looks to me, when I look at the dollar on an international scale, the dollar is basically just planed out. It's sort of flatlined. And I know you were looking at some of the bond yields earlier, since the Fed did release minutes, no expectation of interest rate rise. Well, obviously no interest rate rise occurring, and we don't really know what the next expectation of potential interest rate rises will be. But it just depends on what kind of dictates the Fed to make that decision going forward. So what are you seeing in the bond yields?
Well, I'm seeing the 30-year almost exactly at the 10-year, and I haven't even looked at the shorter-term treasuries.
Sure.
But they're right there together. I don't know why anybody would buy a 30-year at this point.
I'm speechless. I don't either. I don't know why anybody would buy a 10-year personally, but maybe that's just me. Yeah, and that's interesting, right? When your 1 year is higher than your 10-year, that's interesting to me in a rising interest rate environment. I guess it kind of makes sense. Eventually, we'll be at the point where the 10-year should be higher than the 1 year, but maybe that takes years and years of rising rates. No bank wants to lock that rate in.
Well, that's what happened to SVB.
Yeah.
But the problem is the Fed's painted itself into a corner. They are drawing back down on their balance sheet, which I'm sure you've got that chart hidden somewhere, because they had that spike when SVB went down and then Signature, and they had to increase the balance sheet. So they're drawing the balance sheet back down.
Mm-hmm.
But the biggest issue is that they're not raising rates now. What options do they have? I mean, our government is not pulling in the horns. They are not cutting spending.
No. So
we know the only path forward for the Fed is to continue to print to cover the deficit. With the de-dollarization trend occurring, central banks are not net purchasers of treasuries anymore, but they are net purchasers of gold. So if you're going to be
internationally. Yeah, international central banks as a whole.
Yes.
Yeah.
So what does that mean for us long term? I'm a gold bug, unapologetically a gold bug. I know gold isn't going to stay down here for very long.
No, and I completely agree with you. Because like you said, you look at the spending plan. I mean, it was a couple weeks ago we were talking about the whole government shutdown and raising the debt ceiling and all that stuff for the 200th time in the last 5 years.
And everybody's forgotten all about it.
Yeah, I haven't heard a word about it in 2 weeks because they fixed the problem, except they've already overspent what the new raised debt ceiling is before they even raised it. So it's all smoke and mirrors.
It's kabuki theater.
Yeah, and we've said for years that it's a multi-pronged approach that the Fed has to take. They have to raise interest rates. They have to lower the balance sheet. And I would also argue that the U.S. government needs to decrease spending. But Biden just passed new spending bills. So it's a velocity thing. It's not just the speed at which this is happening, but it's the velocity at which the speed is increasing. And the thing is, unlike the speed of light, when you get into an inflationary system, you can now run the digital printing press ad infinitum at a higher in velocity every day. There is no speed limit to that which they can print nowadays. And if you continue to use a infinite currency to trade finite resources, the price of everything is just going to continue to rise at a faster and faster pace. Now, we haven't gotten to the point yet where that happens on a daily basis, But I got a college roommate from Zimbabwe that knows what that feels like. And we all know stories of people from Weimar Republic, Germany. Somebody's grandpa was there. And we have some clients who were too, although they are unfortunately getting to the not here anymore ages. I don't see a solution to this problem that doesn't involve the three-pronged approach. You have to raise interest rates, you have to cut back on the Fed balance sheet, and you have to decrease government spending. And you have to do all three of those things simultaneously. And I think their devotion to Keynesian economics and this human fixation with being smarter than the universe that we keep getting proven wrong about over and over, but we keep trying it over and over. I don't think Keynesian economists are smarter than the free market are. And I think we're just seeing the beginning of that going forward. So I don't know what you do either besides own things like gold. I guess that's why I work here.
Well, but the vast majority of Americans are waking up, and we're seeing that on a broad spectrum, whether it's the media or the political branch, or looking at the leftist ideology regarding whatever the leftist current topic du jour is. And I don't want to go down that road, but people are seeing past that, and they're starting to realign their sources of information so that they themselves are not propagandized.
I like that. Let me say that back to you real quick. Realign. Say that one more time.
They're realigning their sources of information.
Realigning their sources of information as to not be propagandized. See, now that is a New Year's resolution I can get behind. So realign your sources of information as to not be propagandized. Great. I don't know. Are you talking about me and my show? That would make me feel real good, Rob. You don't have to be. It's fine. All right, let's see here. We covered gold. We didn't get into a ton of the white metals, but it's a similar story, just bigger percentages. Silver down, platinum down, palladium down. Tori and I talked about the palladium-platinum relationship last week. I mean, who cares that platinum's down with palladium going down faster? So that's nice. Gives you a better opportunity to those of us that have been buying platinum for the last few years and maybe add a few ounces. Silver, same. Identical to gold, just deeper impression. So you look at those long-term trends we were talking about. You look at the seasonal, you look at the technical, you look at the fundamental, you look at those long-term fundamental trades, and the technicals kind of start to make sense when you sort of piece it all together. So I'm not too worried, except for I think you're right. I think we're running out of opportunity time here.
Yeah.
If the seasonal holds true in 2023, like it has done more years than not.
Right. I mean, it's 2 out of 15 years.
Yeah, it's something like that. I'll have to go back and double check. But yeah.
So it does look like we are fast running out of time for an opportunity to buy at these levels, in my opinion.
True. And the only thing that's quiet right now, other than the Dow that can't go higher, is the U.S. dollar, which seems to have found a nice, comfortable spot around 103. And we'll see how long that lasts if we get into another massive inflationary push, another big central bank balance sheet increase or decrease, and then, of course, interest rates. But the dollar value has a lot to do with what's going on in other countries as well.
Amen.
So that's going to do it this week in Golden Rule Radio. We appreciate you stopping by for this little recap on what's going on in the markets, kind of on a bigger scale, and looking at the types of things that we think are important to focus on when you're trying to figure out what's happening out there in the markets, both metals and otherwise. So we thank you for stopping by. Rob, thanks for jumping in this week.
Thanks for having me,
Always
Miles.
appreciate it. Yeah. As always, if you liked what you heard, do the YouTube stuff. So thank you for that. Better than that, though, is why not sit down and chat with one of the advisors here about your personal precious metals portfolio? We'd certainly love to chat with you. If there's anything we can help you with, we can be reached at 800-525-9556. We're on Facebook at McElvaney Financial and on Twitter at ICA Gold. Thanks for listening and have a great week.